their trades ahead of time. They're not like the average retail trader that just sort of willy-nilly jumps in and out of the market. These guys plan what they want to trade. They have a distinct trading methodology, and they're going to know probably as much as months ahead of time what they're anticipating based on certain price levels. In other words, back here in March, if they're anticipating price to be higher by May or June, and prices are higher by May or June, they have a specific plan for that. Had prices continued down and it was about at the same price, they would have plans for that. That's my point. Is I'm not trying to say that they have some sort of crystal ball. I'm simply trying to illustrate the point that they plan their trades. So you can bet that professional money has been planning for price to come back down here. So when you see big spikes in volume with the market moving down, then what you know is that the professional monies that are the professional traders that are trying to buy have the inventory to buy. You have to remember that even though we're dealing with currencies here, there's still a finite supply of them. Okay, it's not like central banks world over just print up money willy-nilly. You could make the case that some countries do, but the more sophisticated countries like the UK and the United States keep a control on money supply. In fact, at one point in time, when Volcker was the Fed chief, he felt that controlling the money supply was the key to controlling the economy. And various Federal Reserve central bankers keep to that type of monetary policy. So you have to understand that even though we're dealing with currencies, we're still dealing with inventory. And when you're talking about the market moving and big banks making trades for clients, they may or may not have enough pounds or enough dollars on hand in order to fill a trade at a specific level. So then either that bank is going to have to dip into their reserves or go out and get supply from somewhere else. But the case in point, and I'm sorry to digress there, the case in point is that when there are large amounts of sellers, that means that is the time when the buyers can then step forward. Because without sellers, if you're just trying to buy big blocks of, I don't care what, TVs, computers, pens, drinking cups, pounds or dollars, if you're just in there trying to buy huge amounts and there aren't any sellers to sell to you, price is going to get marked up very quickly. It's just the law. It's the law of supply and demand, folks. You can't argue with it. I didn't invent it. It's just the way the market works. So, how then do we look at the market? Well, we start looking for bursts of buying. One way is to look at the range of the bar. Okay, so from high to low, you can see that this was a very big week. In fact, this 1 week is a bigger range than the prior 1, 2, 3, 4 weeks nearly combined in terms of range. So this is a wide range bar that managed to close on the low, which indicates selling. Now, what's interesting to note is that this week, although it is pushing up just a little bit, is up, which indicates buying. Now, to beat the horse to death, if the volume this week was mostly selling, the market would be going down. If this week was all selling, then you wouldn't see the market closing up off of the low. You'd see it closing near to the low like this. Okay? So we're starting to see buying come into the market. We're seeing buying coming into the market at a price where market participants had difficulty buying price above, all of which points to the likelihood that price is going to move up. I mean, it really is that simple. So at this point, the likely direction on the short term is that the market's going to go up.